Most people start investing with the same picture in their head. They imagine putting money into the market, letting it grow quietly in the background, and one day waking up financially free. But that's not what happens for most beginners. Instead, they feel confused. They feel unlucky. They feel like the market is rigged against them. And eventually, many of them quit. Here's the truth no one tells you. Most beginner investors don't fail because they picked the wrong stock. They fail because they fall into the same psychological traps over and over again. Let's break them down. Mistake number 1, believing you can outsmart the market. At first, investing feels like a game of timing. Buy at the bottom, sell at the top. Simple, in theory. In reality, even professional fund managers with billion-dollar research teams can't do this consistently. The market doesn't ring a bell when it hits a low. It doesn't send you a notification when it peaks. Most beginners wait for confirmation, and by the time it arrives, the opportunity is already gone. Trying to time the market usually leads to buying late, selling early, and repeating the cycle. Mistake number 2, letting fear take control. This one is emotional and dangerous. When your portfolio starts dropping day after day, your brain switches into panic mode. Logic shuts off. Fear takes over. We saw this clearly in early 2020. Markets fell fast. News was relentless. Everything felt uncertain. Many beginners sold because they thought they were being responsible. But those who sold locked in losses, while those who stayed invested watched markets recover and eventually reach new highs. Volatility isn't a signal to escape. It's the price you pay for long-term returns. Mistake number 3, chasing whatever is trending. This mistake feels exciting until it isn't. You hear about a stock or coin everywhere. Social media is full of screenshots. People claim they doubled their money overnight, so you jump in. But by the time something becomes mainstream, the biggest gains are usually already gone. We've seen this with meme stocks, hype cycles, and speculative booms for decades. Latecomers don't get rich. They provide liquidity for early buyers to exit. Real investing is boring, and that's a good thing. Mistake number 4, putting all your eggs in one basket. Some beginners believe concentration equals confidence. They go all in on one company, one sector, one idea. But concentration doesn't reduce risk, it multiplies it. History is full of examples where safe companies collapsed overnight. When that happens, diversification is the only thing standing between a bad year and a financial disaster. Spreading risk isn't weakness, it's survival. Mistake number 5, ignoring the silent wealth killer. Fees don't feel dangerous because they're invisible. A percent here, a fraction there. But over decades, those small numbers compound against you. High fees don't just reduce returns, they steal time from your financial future. That's why low-cost investing matters so much. The less you give away in fees, the more your money gets to work for you. Mistake number 6, investing without a clear plan. This is where many beginners feel overwhelmed. They buy a little of everything. Stocks, crypto, commodities, trends. Every day feels chaotic. One asset is down, another is up. They don't know what success even looks like. Compare that to someone with a clear objective, like long-term retirement. They follow a simple strategy. They rebalance occasionally. They ignore daily noise. Clarity creates calm. Confusion creates stress. Mistake number 7, expecting fast results. This mistake ruins more investors than any crash ever could. Many people secretly believe investing should work quickly. When it doesn't, they get impatient, they take bigger risks, they abandon discipline. But markets don't reward speed, they reward endurance. Some of the best performing investments in history looked terrible in their early years. Those who quit early never saw the payoff. Time, not talent, is the real advantage. Successful investing isn't about prediction, it's about behavior. The market doesn't punish beginners for being inexperienced. It punishes them for being emotional, impatient, and reactive. If you avoid these traps, you don't need to be brilliant. You just need to be consistent. The biggest risk in investing isn't losing money in the short term. It's giving up before compounding has a chance to work. If you found this helpful and want to build wealth the slow, boring, effective way, subscribe. This channel breaks down money, psychology, and long-term strategies that actually work. Thanks for watching.